This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Mike Savino. The boom of the last 2 years has brought thousands of new originators and other workers into the mortgage industry. But as loan activity returns to normal, companies are cutting their staffing levels back down. And now we have the biggest shoe to date to fall. loanDepot has a plan to try to turn a profit, and the biggest part of that plan is to shed another 2,000 jobs from its payroll. loanDepot started the year with 11,300 employees and has already reduced its workforce down to about 8,500 workers as of June 30th. Now, these additional cuts would bring the company down to about 6,500 employees, meaning loanDepot by the end of the year will have reduced its workforce by almost half. The company's Vision 2025 aims for an annualized savings of between $375 million and $400 million. The company reported a $91 million loss in the first quarter of this year and halted regular quarterly dividends for the foreseeable future. loanDepot says that the plan will address current and expected trends in the market, setting the company up for success going forward. After 2 years of record-breaking volumes, the market has contracted sharply and abruptly in 2022. We're taking decisive action to meet this challenge head-on. The company did not elaborate on where the job cuts would occur or how many would come in the form of layoffs. Vision 2025 isn't just about job cuts. loanDepot also says it plans to do a better job working with first-time homebuyers and underserved borrowers. It also wants to follow through on previously announced initiatives, such as an all-digital home equity line of credit. Meanwhile, former Sprout employees are fighting back after their layoff, filing a lawsuit for unpaid wages and other compensation. 2 closing disclosure specialists filed the lawsuit in U.S. District Court in New York, but they're seeking class action status. The lawsuit simply says that Sprout let go of at least 100 employees, but according to various sources, the company let go of more than 300 people when it abruptly closed its doors last Wednesday. The lawsuit says that Sprout CEO Michael Strauss directed other individuals not to pay the outstanding wages owed to the terminated employees. The layoff came just 1 day before payday, and employees have told us that they were not paid. The lawsuit says that this violates the Federal Labor Standards Act. The 2 employees also say Strauss and Sprout violated reporting requirements under the Federal Worker Adjustment and Retention Notification Act, which mandates that companies are supposed to give 60 days notice before mass layoffs or closures, and New York's WARN law requires 90 days notice. Sprout did not make any such filings and gave employees only a few hours notice before a virtual meeting. It was at that virtual meeting that Sprout President Shea Palante informed employees that the company was closing and that they were out of jobs. Neither Sprout nor Palante have responded to our request for comment. The employees are also suing Rokavco Mortgage Management, saying that Rokavco and Sprout are essentially interchangeable. Last week, a former executive told us that Sprout had a deal in place to get funding from Citibank, but Strauss changed his mind at the last minute and killed the deal on Wednesday, hours before Palante told the employees that the company was closing. And finally, mortgage rates remain well above where they were even at the start of the year, so it should be no surprise that some borrowers are having a harder time accessing credit. The MBA's Mortgage Credit Availability Index dipped by 0.3 of a point to 119.6% in June, a sign that lending standards are tightening. Conventional lending standards actually loosened a bit, with that index rising by 1.2%, but that was wiped out by the government index, which dropped by 1.7%. The MBA says that the drop in the government index was driven by a reduction in offerings for streamlined refinance products with the FHA and VA. But even with conventional lending, there was a reduced supply of lower credit score, high loan-to-value rate term refinance programs, but the decline was offset by increased offerings for conventional ARM and high balance loans.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on those and all of today's top stories, go to mortgagenewsnetwork.com.